Major support for these broadcasts is provided by Bank of America Merrill Lynch and Perfect Building Maintenance, New York Community Bank, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, All Nation Renovation, Bingham McCutcheon, LLP, Briarwood Organization, Capital One Bank, Cassidy Turley, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Chelsea Lighting, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Hal Fettner, Durst Fettner Residential, Friedman LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Investors Bank, Jack Jaffa and Associates, Real Estate Consultants, James D. Kuhn Real Estate Center at Syracuse University, Corman Communities, Madison Realty Capital, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Massey Knackle Realty Services, Meridian Capital Group, Newmark Knight Frank, SITECOMPLI, Sterling and Sterling, SJP Properties, Stonehenge Partners, the Wickoff Group, Urban American, ACKMAN ZIFF Real Estate, Eastern Consolidated, Goldman Properties, the Moynihan Group, Muss Development, RAL Development Services, the Spandrel Group, LLC, Triangle Equities.
So here we are in the fall of 2011, and some people have called me over the years Dr. Doom and Gloom. But, you know, I don't know, August came, downgrading, a lot of things happened, and, you know, how is the market? You know, how did we look for 2012? So today I've assembled 4 counselors. You know, the counselors, the advisors to many major real estate people around the country, specifically in the region, to provide their insight on the state of the market. My guests today include Stephen Rabinowitz, who's the chairman of the New York practice for Greenberg Traurig, Stuart Saft, who is the global chairman of the real estate practice at Dewey and LaBeouf, Alan Hammer, who's a senior partner at Brock Eichler, and last but not least, Dennis Russo, who's the co-chair of the real estate practice at Herrick Feinstein. So, Mr. Russo, how do you look at, I mean, the beginning of the year was really great. How do you see us in October, November of 2011? How do you see the market?
You know, I think it depends. When you talk about the market again, what are we talking about? Are we talking about New York? Or are we talking about the rest of the United States?
Let's talk about the region.
Let's talk about the region.
Okay, Alan's in New Jersey, you know, Stuart sees it on a global, you know, Steve sees it in a regional situation, but, you know, he sees the national situation also, and so do you. But how do we see our specific market? Even though people watch me on YouTube and iTunes, how do you see this market?
Well, I think
and let's not say only Manhattan, because Manhattan is different than the rest of the market.
Okay, I'll go for the region for you. I think it's going to be spotty. Reality is that with the stock market doing everything that it's doing, ups and downs every day, people get nervous. But I think after a period of time, people getting used to it going up and down every other day, they'll feel some sort of what differences and make stability. Certainly hotels are big, as I may have mentioned before. We're doing a lot of hotels in New York, and that doesn't just mean this rock. However, I must say that whenever clients call from anywhere and they say they want to be in New York, I say, well, how would you like a place in Queens? No. How about a place in the Bronx? No. Just this rock they want to be on. A lot of them, not everybody. So the hotel companies, hotels are hot. We're still building a number of hotels for our clients. People are coming from out of state to build. Everybody wants to have their trophy spot right here. That's hot. Lending picked up until CMBS went and had a little bit of trouble here. However, there are a bunch of lenders in the market now that are making a great effort, as most of my colleagues know. Wells Fargo, the CMBS is slower now, but Wells Fargo is hot. They don't even have enough people to get the work done. Bank of America is out there in a big way. There are a number of other banks that are out there. So you're going to start seeing some financings. We're seeing financings happening here and there.
You know, you're seeing financings, but you know, I do shows every week, and I have lenders, and I've done panels, and basically the lenders are saying the following: yes, we're lending to well-established, well-capitalized borrowers.
All true.
And they're not. I mean, a couple of years ago, and there was a great article. I mean, that the young reporter wrote about One Madison Park this past week. I mean, this is the reality. In 2004, 2005, the banks, the Fremonts, the Choruses, the others were saying, "You want to build? Build." We didn't care. We don't. I mean, today, what do you see? You're not going to have an inexperienced person the bank is going to lend.
Agreed. I mean, what we're seeing is a lot of activity from quality sponsors. The REITs are active. REITs have their own balance sheet. They don't need necessarily leverage, or they certainly don't need leverage at the levels that a private sponsor developer needs. And we see a lot of activity from the REITs, both in the hotel area and the multifamily area. And we see that good sponsorship borrowers can still borrow money, can still recapitalize properties. But I think where there's uncertainty are the more entrepreneurial owners and operators who don't have the access to the capital, to the debt capital that they did 4 or 5 years ago. There's still a lot of private equity capital on the sidelines waiting to do things. But until there's more product on the market, that capital seems to be sitting on.
What kind of product are you seeing? What are your clients doing?
Well, we're also seeing hotels. We financed in 2 packages about 15 hotels across the country earlier this year on behalf of a senior lender. We're seeing a lot of activity on the multifamily market, particularly in New York. The problem is that we have many clients chasing a few deals, so the cap rates at this point make no sense whatsoever. And the debt stacks are as strange as they were 4 years ago. I thought after what we saw that the mezz market would disappear, but the mezz lenders are as strong as ever, and they're helping to make these things move forward. We haven't seen as much activity in the commercial market, but I think that's because a lot of the properties are still underwater, so it's difficult for them to change.
Alan, what are you seeing? I mean, you're on the other side of the river, okay? You're in New Jersey, but I know you have an exposure all over. But what are you seeing in the Garden State and in your markets?
What I'm seeing mostly in my market, in the Garden State, and I do all kinds of real estate in New Jersey, all investment property, but I'm seeing a lot of financing, a lot of refinancing, at very low interest rates, a lot of apartment house refinancing. I do a good portion of what I do is apartment house stuff. But what I'm seeing that's unusual right now, I can't think, I have very few deals under contract for clients in New Jersey. Got a lot in Maryland, Virginia, Massachusetts, New York, and Pennsylvania. But there's very little trading in New Jersey right now. And the things that are trading in New Jersey are at cap rates that are just silly. Not just are they low cap rates, if you're in the business, they're a lot lower, I think, than some of the buyers think they really are. So you've got buyers think they're buying 5s and they're buying 4s in the apartment product. And there's very little transactional activity in office buildings in New Jersey because the office buildings are either full and then people aren't selling them, or they're far from full and nobody wants to buy them. There's very little industrial activity right now. The hot market is apartments. But it's so hot there are few transactions. People who own them don't want to sell them.
What about new construction?
I'm not seeing a lot of new construction.
A
little bit here and there, but not.
Even what we call the sixth borough, that one might say, of the Jersey City, Hoboken?
There's a little of activity there. You know, people talk about Hoboken. Hoboken's a 1 square mile. Whatever you hear about, there's not a lot of real life activity. It's like a block in New York. There's activity, but it's not really a lot of activity. In Jersey City still does a little business, but I don't know. It's almost for New York people who can't find something in New York.
You know, I was talking before about the office market, and I said that Stuart had arrived, you know, prior to the show, and I was saying to Stephen that people are since August have really slowed down their decision making on people signing leases, but they're not signing leases unless they really need to, and they're taking less space. What are you seeing with regard to the office market?
More activity than we saw a year ago, but still not a ton. What we're seeing is consolidation. People who might have multiple locations trying to consolidate into one place. And I think part of that is facilitated by the fact that people in businesses like ours, service businesses, financial service businesses, have much less need for space than they did even 5 or 10 years ago because of changes in technology and the way people work.
Now, you were bringing it out that the national, I mean, you're a major national firm, that you moved a lot of your word processing to.
Right. An example of that is we have a national platform, so we've always had the ability to move a lot of our non-primary functions to markets where we could produce it cheaper and have cheaper real estate. So we've traditionally had our accounting function in a facility in Miami, not in our main office in downtown Miami, but in a satellite location. We have our research function in Phoenix, and we recently entered into an agreement with a third-party contractor where all of our national word processing is going to be handled in a facility in North Dakota, which is going to create efficiency, is going to create the ability to free up expensive real estate in a market like Manhattan.
Now, didn't you a couple of years ago take a large amount of space in White Plains to move some of your people for lower cost and to save because you didn't need the people?
Well, you know, our White Plains space is interesting in that it was originally intended as space for disaster recovery, but again, as technology changed and the need for a specific disaster recovery location diminished, we built a practice up there, and now have the office substantially filled with a great real estate practice that's primarily real estate, but we also have a great litigation practice up there, securities litigation practice, and it's actually been a great success for us. We're not using the office for what we originally intended, but we're actually you know, driving great revenue out of it.
They call it readapt, you know,
Absolutely.
readaptive. Now, you have Jersey offices, and
Yes.
so do you, okay?
Yeah.
Okay. You have an office in Princeton?
Princeton and Newark, and those are also pretty full. We do the same thing that you do, which is, you know, we even have attorneys that get paid a little less over there, so we can price things in certain ways. No different than when, you know, some of the larger firms, when CMBS came around, all of a sudden you found that the deals were being done by some kid in South Carolina. That probably turned out to be a mistake now, but you know, we have the same quality lawyers. They're usually, you know, trained of equal caliber, and they're there.
You know, prior to the show, I was talking, we bring up Newark, and, you know, you live up in Westchester in the suburban markets. There have been major leases transacted in the state of New Jersey. Pearson is moving part of their property to Hoboken. Panasonic is opening up in Newark. And they're really opening up because the state is giving away incentives that New York City cannot even meet. Do you think that's going to change the world in Newark and the other suburban markets?
I hope it does. I don't see it. There's a lot of conversation about Newark. It's got a great mayor, but I don't really see a reason. I don't see Newark coming back, or I don't see it prospering. I'd like it to. It'd be very good for New Jersey. It'd be very good, but I just don't see it at all. I see the future of Newark, and I'm surprised why it hasn't reached this as housing for New York City, for the worker, for the New York worker.
A good example on that is, you know, Cogswell a number of years ago went to Newark. They built something. I went to see the property. It happens to be right near the Gateway Center. It's not far away.
Yeah, it's great.
And right now it's being foreclosed on.
1180.
I mean, and the pity is, you know, you're talking about a differential. Manhattan rents. I mean, these were nice apartments. You could pay $22 a square foot. The problem was there were no amenities.
Right, there's no retail.
You know, there's absolutely no retail. At least I did a Long Island City show. We're talking about they have large Duane Reads in Long Island City. Newark, they don't. They don't have restaurants.
Well, I think you raise a good point about where where real estate is going. What we're seeing a lot of, and I don't think that you can ignore, is the access to amenities. And I think that's why a neighborhood like Williamsburg or Harlem are actually coming back stronger than anyone expected, because they're walkable neighborhoods with great culture, with great restaurants. And I think the areas where you continue to build that way and maintain that kind of culture are the neighborhoods that are going to come back. And one thing that we're seeing a lot of activity in now is retail. Retail condos are still very, very hot. We see a lot of activity in healthcare, and we see a lot of activity in education. And I think that especially the investment in education and healthcare as the country gets a little older, I think are going to have a great impact on where people build and where real estate maintains value.
I just want to comment on your Cogswell comment. I don't think the amenities played any part of that at all. I don't think there was any reason to live in Newark and pay the rent. I have properties in every major community in New Jersey, or most of the major communities. I don't have any amenities. I have one amenity. I have one very substantial amenity, which Dennis is very comfortable with, New York City. I mean, that's my amenity. We're close enough to come to New York. Now, Newark has got that amenity.
Newark?
Closer than anybody, but there's no reason to live in Newark when you can live in any other community.
But Steve just brought up an interesting thing about education. Newark has Seton Hall, has a lot of education, and I did a show in Long Island City, and they were talking about the economic development, talking about Stanford coming here with Cornell, and MIT and other places are planning to come to Queens. There's a major thing in Southwest Queens and maybe Roosevelt Island. So that's going to have a major effect in the economy, and that's going to help. How do you see the condo market?
Condo market is very strong. The prices softened a bit when the financing disappeared. What we're seeing now is a great many landlords and investors are starting the process of putting in new offering plans, knowing that the process takes about 2 years before they can actually close, and figuring that by 2013 the market will be significantly stronger. We have a number of, I think we put in 4 or 5 offering plans last month alone, which was, I think, 5 more than we had done in 2010. And we have a number of clients who are buying inventory for the purpose of converting it. So that market is strong. And I agree with you with regard to retail. We've done a number of condo conversions of commercial buildings to sell off the downstairs retail, because it's just a very big market.
I did a show on retail 2 weeks ago, and I had one investment sale. I had a very good combination, a banker, investment sale, and so on. Retail condominiums are doing fantastic, especially if it has a bank in it, a TD or a Chase or something like that. These investors want that like hell. And regarding what you said about Harlem, I had the developer of East River Plaza. It took him about 15 years to get it over with, and he was saying how great the Target, the Costco, they're doing in that development. I mean, they have like an 88% occupancy, and they could get higher. And I happened to go there this Sunday. It's really doing well. No one's complaining about the $5 parking.
Except my wife. My wife is complaining about the $5 parking. You should know.
Go to Long Island City and go over the bridge.
I
The good part, I used to say when I did my New Jersey shows, what saves the retail in New Jersey is there's no sales tax on clothing. If they ever had to put sales tax on clothing, it could have a major effect in the New Jersey retail market.
When it comes to condos, it certainly is. I'm amazed at what now air rights are transferring for. I have one project in the Highline area, which is just, we have clients that are buying up there, what's ever left, pretty fast, and they're willing to sit on it. And air rights, we're just selling air rights on one. And again, there's a limited air right pool there, so I can understand that. For $500 a square. $500 a foot, as may go. I've got another one basically.
Is that right on the High Line?
Yeah.
I think you guys should talk about New York, though.
Yeah, we are.
Talk about, I know you are, but if you talk about condominiums in the rest of the country, residential, or I don't think there's such a thing as a retail condominium once you get out of Manhattan.
No.
And a residential condominium exists, you just can't sell them. Almost any market that I'm aware of, and I see a bunch of markets.
I mean,
it's all New York City.
Because the properties in New Jersey are not selling residential.
There's no conversion. We haven't seen a conversion to condominium in New York in years.
In New Jersey.
In New Jersey.
But you have to remember, we have this housing shortage here that's gone on for the last 60 years, and it's not disappearing.
How do you see the boroughs? I mean, Stephen brought up, we were talking about Williamsburg. What about the other boroughs? I mean, do you see Queens or Staten Island or the Bronx, anything?
In point of fact, yes. There was a point 20 years ago where people would move from Manhattan to Brooklyn and Queens because they couldn't afford Manhattan. Now we've reached the point where they can't afford Brooklyn and Queens. There's been tremendous population growth in both of those boroughs.
I mean, I think you bring up a really interesting, I remember, and I was joking, I was picking on lower Manhattan, downtown Brooklyn. Downtown Brooklyn 2 years ago produced close to 1,950 residential rental units. They've been all absorbed. And they're absorbed, and now the rents are $42 a square foot. I mean, and there's limited amenities on Flatbush Avenue. My joke was, how many cheesecakes can Junior supply to everybody on Flatbush Avenue?
Well, that's $42 a square foot. Recognize, I think you're talking about the new buildings that are built, which happen to be spectacular. I was in Brooklyn not but a few weeks ago, and I was shocked. I mean, I started out as a developer years ago, and I still own stuff there. And the stuff that we own in Fort Greene and the South Slope, it's amazing what it's become. Brooklyn is a place where you go because you want to go.
Yeah.
It's not necessarily just saying, oh, gee, I can't afford Manhattan. That's not true. I mean,
but you see, what we did bring up, and the office market in the boroughs is not Manhattan. Even though there's a savings, there are REIT benefits, it's not Manhattan. Long Island City, whatever office space there is $25 to $30. Brooklyn is $20 to $30. So it's a different market going into.
So is Long Island. So is New Jersey.
Yeah. So what do you think of the Long Island market?
Long Island market. Look, Rexon has done very well there over the years, needless to say. So you can't really look at it being that bad.
Yeah, but
does it have the kick that you have in New York? I have a client that's a New York-based client that bought a few buildings in New Jersey, and we service those buildings, do a leasing for them, the whole 9 yards. He says to me every day, I wish I didn't buy it because I could have spent my money in Manhattan.
It's like Alan was saying about New Jersey office space.
I think Long Island is different than New Jersey.
It is.
I think 20 years ago, Nassau and Suffolk County were really just suburbs of New York City, and I think they've developed.
They've become on their own.
Absolutely.
The negative on Nassau County is the real estate taxes in Nassau County are prohibitive, and in certain cases they can be as much as the rent on a base situation. Westchester, what happens? I mean, you have an office there. What do you see happening over there?
I'm not that active in that market, but we continue to have clients who are engaged in some development, affordable housing, northern Westchester, a lot of refinancing activity. I really don't see, not because it's not happening, but I don't see in my own practice that much happening.
Here's an interesting question that relates to 2012. The entire real estate market today is surviving in this region and around the country because of the low interest rates.
Yes.
Now, what happens if rates go where they should be? I mean, Alan, many of us sitting here, except for him, he's too young. No, remember when there was an 18% prime, and
I remember that too.
Oh, you do. Okay.
I had a loan floating and it hit 21, and I called the bank and I said, "Can I lock my rate?" I was at 21 on a small apartment house in New Jersey.
So my question...
You won't see that happen, though, until we have some reasonable inflation in order to build the assets. Because if that was to happen, you'd lose all the rest of the banks.
You don't believe that inflation is happening in New York City and in the region?
I believe
the prices are going up on everything?
Yes, but it has nothing to do with government policy.
Nothing relating to interest
rates.
Right,
interest rates.
To do with cap rates.
Except that every time you've had inflation, interest rates and inflation go hand in hand. always, except for right now.
Have you seen food
the
prices?
reason it's not, but the reason it's not going hand in hand right now is because of government intervention
Right.
on a global basis, not just the Fed, and on a global basis, and an increase in interest rates would be devastating to the world economy right now. Imagine what would happen if it happened in Europe. So I don't think we're going to see it in the near term, but certainly it could happen. I mean, I'm not an economist. I'm a real estate lawyer.
I think you're going to see a different
You're
problem.
the counselor.
I think you're going to see a different problem coming for real estate coming out from where we are, because there's so much movement right now on increasing government revenues and looking at flat taxes and eliminating deductibility, that the question becomes what happens in a high tax jurisdiction such as New York City if suddenly real estate taxes are no longer deductible.
What if interest and real estate taxes are not deductible? What effect is that going to have on sales of homes and condominiums? People buy it for that reason.
Yeah, but I don't think. Yeah, but I
Can't take it away.
I think
You're right, you can't.
You can't take it away because it's effectively an entitlement. But there are so many macroeconomic factors that will. That's not going to happen in a vacuum. It's not that real estate tax is going to become and interest won't be deductible, and the rest of the economy and tax code will be unchanged. So you really can't predict.
So with 1 minute left, how do you see 2012?
I can say for us, we're optimistic. You know, we've been hiring and associates and growing for the first time in years. While the horizon for our work is not as far off as it used to be, you can't look at 4 months and 6 months and say this is what we're doing. It's still comfortable.
Stewart.
I look at 2011 as being schizophrenic. It's been up and down and up and down. But based upon what I see right now, I see 2012 being far stronger than anything we've seen in the last 4 years. There's a lot more deal flow. There's money beginning to percolate, and we're getting a lot of interest overseas about investing here. So I think we're finally coming out of it.
We're busier than we've been in years. The occupancy in our apartments are the highest it's been in a number of years. I don't see any reason for 2012 to be better, though. I don't see the fundamentals don't exist.
But you're saying 2011 has been a better year, so it should be similar.
But I don't see the fundamentals in place for continued improvement.
Again, I mean, for the region, not talking about, out west.
Right.
'Cause it's a whole other conversation.
And you got 20 seconds.
That's exactly where it goes. We too, by the way, are expanding since the first time. We never really cut down that much, frankly, but we're expanding. We're hiring associates, which is a great thing. I mean, is the work going to be there? I think so. I see all the indications that it will be there.
So the counselors to the community have rested their comments, and it's cautiously optimistic. I give it in that manner. And I'd like to thank Stephen Rabinowitz, Stuart Saft, Alan Hammer, and Dennis Russo. See you next week.
Major support for these broadcasts is provided by Bank of America Merrill Lynch and Perfect Building Maintenance, New York Community Bank, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, All Nation Renovation, Bingham McCutcheon, LLP, Briarwood Organization, Capital One Bank, Cassidy Turley, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Chelsea Lighting, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Hal Fettner, Durst Fettner Residential, Friedman LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Investors Bank, Jack Jaffa and Associates, Real Estate Consultants, James D. Kuhn Real Estate Center at Syracuse University, Corman Communities, Madison Realty Capital, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Massey Knackle Realty Services, Meridian Capital Group, Newmark Knight Frank, SITECOMPLI, Sterling and Sterling, SJP Properties, Stonehenge Partners, the Wickoff Group, Urban American, ACKMAN ZIFF Real Estate, Eastern Consolidated, Goldman Properties, The Moynihan Group, Muss Development, RAL Development Services, The Spandrel Group, LLC, Triangle Equities.